Well, cool. Let's go ahead and jump into it. This is going to be an open forum, happy hour. However, I'm going to introduce Lena here in a moment, and she's going to sort of guide us through this. I am going to just assist in the process here. Super excited everybody was able to jump on for our first happy hour. We are looking at doing these at least once a month and potentially in the future once a week. We'll see. We'll see how it goes. So we are going to ask you guys for your insight and your feedback and any areas that you'd like to um, go ahead and share that you're interested in, and we can do our research and decide which one of our team members would be the best person to lead it. So I'm going to kick off and introduce Lena Sells. Lena, introduce yourself.
Hey guys, I'm Lena. I've been with BigQuest for a little while right now. So the IR team here, have really thought about, what's going on in the market right now. I think everyone is a bit concerned with the volatility of the stock market. So we decided, that we are curious about who's doing what as far as investments besides investing, in private equities. So we're part of what we want to do is, like Sean said, pick a few topics that are hot out there as far as investments go and dissect it. What is the best way to approach a particular investment or topic, and see, who has ideas of, or who does it best, if you will, right? So that's what we're going to talk about today. And I think it's going to relate to somebody like yourself, Jess, and the gentleman that hop off Barry that was running to fix some leak on his rental. So what we're going to talk today, the topic is going to be about fix and flips. And would like to invite you guys to chime in if you have questions, if you have anything to add on, would love to hear it. I think, like Sean said, we're all here trying to get better at, opportunities that come and go. So fix and flips, and the idea that came to me came actually talking about one of our potential investors that was looking at our private equity fund, and he had $300,000 liquid. And we were talking, everything good. And then I followed up with him a couple of times. And then he replied back to me. He's like, I'm not really interested because I can do better than 10%. So I'm like, okay. So I didn't push it further. Again, we're not here to sell, we're upsell. I think, you can't, once an investor is set in a way on what they want to go with, they're going to do it regardless. But I slept on it and I was like, it's like, okay, well, it's like 300,000 that he worked really hard for. And he's like, I'm just going to put it in a fix and flip because I can make a lot more money in the fix and flip. So I was like, okay. So I thought about it. And then I asked him, hey, do you want to hop on another phone call? I just wanted to show you something. So we started going for the numbers. And when we started going for the numbers, what was crazy is that his hard-earned cash technically was going to make him a lot less money and put all of it at risk potentially. And he didn't even see that, or, did not even consider, if you will. So what we did, we broke down the 300,000 that he had. So he was talking about buying a property for 200,000. The rehab cost was 50,000. So his total cash investment was 250,000, right? Now, again, all of it outlaid. Sure, he says that he knows the area and he's comfortable with that. But bottom line is that knowing the area still does not protect you from possible underlying issues with fix and flips. And I think everyone could agree with that. So when we looked at that, again, after all of his renovation costs and everything else, he was going to net about, I want to say 16 to 20%. And he was happy with that, right? Better than 10%. So what do you guys think as far as that goes? Would you be happy with 10% in a private equity fund, or would you be happy with 16 to 20%, but actively working on that? What is your thought on that?
Depends on how much work it was going to take.
And I guess at 50,000, I would wonder, are we talking about a roof and the AC and very little handling on your own? Are we talking about multiple contractors inside the house doing electrical work and plumbing, or flooring or paint, windows? At 50K, it's probably not all of that. It's going to be a portion of that, right?
Right.
So I guess again, it would really depend on the workload and also, mm, looking at the market's future, making sure you're on track with that, just in case, you have changes coming, whether it's huge insurance movements or a hurricane on the way to Florida or something, right?
In Florida today, I'd be even scared to do anything, especially since now we are in active hurricane season.
Hey, but the insurance companies are coming back. We're up to like 11 or 12 now, so that's good.
I,
Well,
I've never, I've never flipped and rehab properties, but I have several friends who have, and almost without exception, there's always a surprise or two that comes up
Always.
that increases the rehab cost. Um, I want to enjoy retirement, so that's why I sold my rental property. I'm tired of dealing with the detail.
so you don't have any more rentals, Jess?
I had three at one time. Now I have none.
Good. I mean, in my book, I think it's a good decision.
I'd say having flipped several properties in the Naples area, there are always surprises and there are always delays. So, yeah, that's why I stopped flipping.
So what was, Christy, on average, what was it, the timeline that it took you to flip?
Come again?
What was the timeline that it took you on average to flip the properties?
Well, that was part of the, um, it would vary from 6 months to more than a year. And so then you get carrying costs and yeah, part of the carrying cost. So
Yeah, I
Yeah.
guess in this case, we're not really tracking the carrying cost in this. That would usually be, some people put that with their rehab cost, as far as holding cost or carrying cost. So at 50K, I'm guessing this would be a 6 month or less for sure. Um, you know, Again, I guess it's all about the risk, risk versus reward. Like Jess said, he's past that time of taking the risk. A lot of us, like I'm mentoring my sons and prepping them and teaching them how to do, buying holes, the Burr method, and a fix and flip along the way potentially, so they have that ability. But they're in their 20s and they could do it into their 30s and 40s potentially. But I'm a grandfather. I'm not looking to take on too many fix and flips.
in our retirement years, and we live in the Midwest. So when I'm trying to flip a property in Naples, that doesn't necessarily work as well as you would hope if you can't find really good people to keep the pressure on, so that contractors get in there and get the job done, et cetera.
Well, that's where the thought came from. And I talked, at length with him, and I'm like, well, have you done any flips? He's like, yeah, I've done a couple, and I've seen a couple of, well, doing and seeing is two different things. So I didn't really get the straight answer. He was just dead set about, he wants to use the money. But what we started getting into, and he was like, well, I never thought about that, is I was like, have you ever considered leveraging the money? And he's like, no, why would I do that? Why would I want the monthly payment, and then, pay all this interest to somebody else? I'm like, why wouldn't you? And he's like, it doesn't make sense. And he was one of those guys that, I don't know, he said that he listened to Dave Ramsey, and Dave Ramsey says that you should get rid of all your credit cards and like any debt and like use just cash, all of that stuff. I'm like, I mean, again, I don't necessarily say that that's the wrong way, but I think it depends. What are you doing in life at the moment? And then you make the decision, do you use leverage or you don't? So long story short, I went with him for this example, and I personally have done it a couple of times and it worked out lucrative. I mean, I've lost a couple of times, but again, you pay the cost for the experience, right? So what I told him, instead of taking all your money and potentially putting it at risk, I mean, again, there is no bulletproof investment, period, right? I mean, to include any private equity fund, to include any, stock brokerage accounts, where, I mean, you name it, there's risk in everything. But the more important part was that the risk was that he was going to use his entire retirement to flip. And I'm like, well, what if you didn't see something where the contractors ran with the money, where something happened? The money is gone. Like, and he's like, okay, keep going. So I'm like, why don't you go and talk to a private lender and bring them the property that you want. They'll wrap around the renovation cost, and they'll ask you probably for a worst case scenario, depending on your credit, for like a 20% down payment. And then you'll need reserves for your interest payments monthly, and then a draw to start the renovation. But you'd still, I told him, for the same scenario that we're talking about, that he was going to use 250,000. I'm like, at best, I would put aside 50 for that and use somebody else's money, and take the 250 that you have on the side, even not 250, take 200 and put it into a private equity fund or in any other alternative investment that you're not using the money, that your risk is spread on multiple collaterals, and it's paying you something, and you know that that cash is safe. So he's like, okay, so how would the numbers work? So we ran the numbers, and he did not have any idea. So he looked at the numbers, and he's like, if he were to make that, his return significantly went up with a lot lower risk. And then we were talking about, well, what if, the property still, and I'm like, it still doesn't mean it's bulletproof. You still could have the same property, the same problems that you would have had with a full cash investment. But if something goes wrong, at least you're not on the hook for all your money to be gone. I mean, worst case scenario, they'll foreclose on your property, you'll lose that property, but you still have the 200 or 250,000 that you didn't use still protected. So again, I think what we wanted to talk about today is like, who has ideas as far as how do you make it best, right? Because leveraging today, I think it's a way better idea than using all your cash, because he was making, after the leverage, he was making a solid return in double digits. Plus he was making at least 10% without even touching his money. So the key to that was like, just take a portion of the money, go play, the rest of it, invest it passively, and just, what do they call it? Mailbox money, right?
That's what some people call real estate, is mailbox money, except a few of us here who've been real estate investors or who have properties know that it takes a little more than just sitting back and collecting in the bank. Yeah, I mean, definitely. I know a few of us here have invested in properties. Paul, I don't know if you have any advice when you diversify. I know you do a little bit of leverage too. I know some people pull private money just to move faster and not have to deal with the banks. Does anybody here have any advice or any options you've done to leverage your capital? It's okay. All right. So yeah, I mean, this is definitely an option for diversifying. I know some people will take and they'll spread out amongst multiple deals. When I was mentoring for Bigger Pockets, a lot of real estate people get jumping into it. They're like, all right, I have a mentor now. I'm ready to do 5 properties right off the back. And I'm like, is your first time doing this? Or I'm like, let's just do one first. Let's finish the first one. And even though they have full ability to potentially deploy, I always push them for leverage. If ultimately they step in and say, no, I want to use all my own capital, I'm against it, just because of this exact reason, especially on their first deal. Having the bank give you, or even a private lender give you the additional comfort that your numbers are on point from what you see, so in case you don't get too excited about a pool or a nice tree in the front yard or whatever it is, or near the beach. On the short-term rental side of the house, I can share with you that obviously those properties make great money, and there's a little bit of gaps during the different seasons. However, my last person I mentored, he thought he'd be ready in 6 months, and it's been over a year, and he has half of it rent out and half of it not ready still. So they went way overboard, way over budget, almost double what their budget was. because they decided to add a waterfall, countertop, and everything else. So,
Got the attached to the property, huh?
yeah, exactly. He's attached to the property, and I think Paul mentioned that earlier. You never know what's going to happen, and he's not near the property either. So, having that extra 20, some people do 30, some even do 40% over. I don't mess around in California, but I know a lot of people who invest in California. They actually do up to 40% over what they think it's going to be, just to have that money ready and still make sure they're going to make a profit. So yeah, I like this ability to be able to protect your capital, still have some kind of cash flow coming in, or even letting it stack if you don't need the cash flow. But if you do have some kind of interest payment, this could help pay the interest and below it, money in your pocket while you're in the middle of a flip, which is great. Or even if it's going to be a buy and hold and you're just waiting to get it rehabbed so you can refinance it. Alan, did you have something?
Yeah, I was just going to add, I learned about something just recently. This is in the self-directed IRA world. In
Yes.
particular, sort of the different flavor of that is the solo 401k world, and a Roth in particular is really advantageous for this. But in that world, in the solo 401k world, you can leverage, you can borrow, get a non-recourse loan to buy a property where you put, a minority of the purchase price down out of your Roth funds, and then you finance the rest. But because if it's a solo 401k, you do not have to pay the UDFI,
Oh,
which is the
nice.
unrelated debt financed income tax. So, and because it all grows tax free inside of a Roth, it's a great thing if you want to get into this kind of, cash flowing real estate sort of one offs. So you can also do it with conventional IRAs, but there is the tax issue, and then you want to kind of pay off that mortgage more quickly, get quicker to ownership. But the solo 401k in particular has legal advantages in terms of what it can borrow and how much can be deposited every year and so forth. So it's a good vehicle to use if you want to get into this world and use that kind of cash, if you have those resources. I personally have kind of, just using individual, what I call ordinary funds, been in and out of the buy and hold and turn into rentals and try to get them cash flowing with multiple properties over the course of my life. And after having a fire and after having tenant issues and, property manager issues, it's something that I personally shy away from at this point in my life. But there are certainly awesome upsides if you really want to, if you have the time and the patience and the energy to go down that route with individual properties.
Yeah, Alan, actually, just to add to that, we actually had a couple people ask about this, and I know they're sort of past, like you and Jess and myself and Paul, and even Lena. I mean, we've all done real estate investing, and we're sort of looking for the more passive-ish money. However, because we have that past, we all know we're going to be asked, and that's why I think these types of calls are great. If we're personally not doing it, now that you shared that with us, Alan, that's something we can share with some of our investors.
Yeah, I
That come
got that
across this.
info from my self-directed custodian. They put on occasional seminars, kind of training
Oh, who
sessions
is it?
and things, and Specialized Trust company out of
Yes.
Albuquerque.
Okay.
Yeah.
Yep.
Edwin is the principal guy there, and he does these things once a month, I think. So I watched it actually this morning, and I had heard about it a year and a half ago, and I sort of forgotten about it, but he kind of refreshed on the whole concept. So it's sort of fresh in my mind, which is why I'm able to mention it and
Yeah.
hopefully describe it more or less correctly. But
Thank you.
Now, Alan, did he tell, would the traditional banks do that, or would it be more into the commercial line of credit, like for flippers and stuff like that?
whoever does non-recourse loans, because that is a
And
requirement when you're using retirement funds. So I don't know. Yeah, I think that is sort of a niche in the finance world. Not every institution is going to do those kind of loans.
yeah, I was thinking it
Um,
might be in the private money space.
mm.
And if they could have access to, but usually in the private money space, they want to have some kind of recourse on the property.
Well,
But
the property, it's limited to just the property, right?
okay.
So they can't go out, that's what a non-recourse loan is that the asset that you put up as collateral
Yeah, so private money
yeah.
is perfect then.
Yeah, they can't go beyond that. So,
Yeah. Backflip or his capital or any of those would be non-recourse. They're all going to focus
mhm,
on as long as you're under that ARV, of course, whatever they're
mhm,
for
mhm.
that area. Like in Florida, I think we can go up to like 80 something. In some states, it might be 70.
Yeah, non-recourse, they typically, the interest rate's a little higher and they want a little more down, but if it makes sense on the property you have in mind, then it's worth looking into.
What kind of,
Yeah, look,
what kind of interest rates are they talking these days?
I think you might be, I'm kind of guessing here, but it's probably 1.5% more than like the best mortgage rate you could get, conventional mortgage, something in that neighborhood.
It's always about, and a lot of times about experience. If they can see your history, that you're not a first time flipper, just read a book, you've done some deals, and you can show that track record, they'll do a little better
Mhm.
deal. First time they do, I do know a few people who've just did their first ones in the last couple of years, and they paid the price for the first one, like buying your first new car, I guess you could say, right? They can charge you a little more, but the
Yeah.
second loan is a lot better. So
yeah, I saw actually, I looked at one of the guys that has a rental in California, as a matter of fact, and he filled out the term sheet and sent it over to me to take a look with one of the guys that I used to work in the past. Well, that did a couple mortgages like that for me, and they gave him a 3-tier term sheet, meaning it's a short term, but it's a rental, right? So it's not a fix and flip. So it's a DSCR, like a 5, 4, 3, 2, 1. So he's looking at 55%. It's 5.8 interest rate. And then at 50, it was actually a little higher. It was like 6 and 6.1, which I thought it was actually, and I haven't looked at any term sheets for, I don't know, like a year. So for a private money lender, I thought that was extremely, doable.
I'll mention one more thing about if you are going into these kind of deals and using retirement funds to do it, and that is, and it's kind of a universal rule when it comes to investing with, self-directed investing with retirement funds, is you can't do any self-dealing. So if you're a super skilled handyman and you want to jump in and fix this rental property that you just, financed and use your retirement funds to take a piece of, that is actually regarded as a prohibited transaction, because you can't use, your own labor. You can't hire your son or your dad or anybody like that to be involved in that property. You pretty much have to go with market rates, so that you're not, I guess the idea behind these rules is that you're not taking advantage of using tax advantaged or tax-free dollars to compete with the taxed economy out there. I assume that's the motivation for those rules. So I've heard stories of people getting in trouble that, certainly don't live in your own, a property that's financed with your retirement account. You're not allowed to do that. You can't rent it to yourself. That certain separation, an extended family, it gets to be okay. But your
Yeah.
self-directed custodians will fill you in great detail about what you can and can't do in these kind of situations.
I would just chime in and say, yeah, lots and lots of restriction when you're
Mhm.
IRA money. And a lot of people burn themselves by not knowing the particulars of all the rules and regulations that are involved. So if anybody's thinking of getting involved in that, cover your backside.
Yeah.
Rebecca,
Yeah,
I saw you unmute, Rebecca. Did you have something?
I was just going to add to Lena on this slide and, how I love it. I'm all about giving your dollar more than one job, and listening to everybody's different strategies. I love how I get a lot of clients, like Lena was saying earlier, with the old way of thinking is like, have no credit cards. Who cares about your credit score? Pay everything off, use cash. But you got to think, if you use cash, what about people forget to calculate lost opportunity cost? So, you're sharing and waiting to build up this cash, but time has gone by. If you would have leveraged someone else's money or yours in a different account, what you could have made up during that time. Another niche and kind of the area I play around in is cash value whole life insurance. So there is no restrictions on that. You can use your brother-in-law and pay him to fix up a house. You can set your terms. If a deal goes a little bit longer, are you going to foreclose on yourself? You just renegotiate the terms. So that's something that with my real estate clients, we're using cash value whole life insurance as leverage.
Yeah, that's on point. I know Alan put his thumb up there because he was at the same event I was just at over there in Hawaii, and a gentleman covered that with us. He's like, "What are you gonna do? Foreclose on yourself and take the property from yourself? I don't think so. You're not
Yeah.
gonna, to do that. So it does give you a lot of flexibility there. Alan, did you have something to mention about that?
Yeah, I mean, and that, whole life insurance, or there's a few other life insurance vehicles that you can use for that, is a really awesome, powerful thing that you can double and triple leverage into other kinds of investments. It's great.
And it's great for people in retirement because it, offsets if you have things in the market and the market's not performing right, you don't have to pull out of those products. You can use the cash from your insurance to offset that during retirement. It lowers your tax requirements during that time. And then if we're all part of legacy, it adds to that as well. There's so much to it that people don't understand. Same with self-directed IRAs. Like, there's these wheel realms, I don't even know how to describe it. It's like when you take the hat off the box and you see all these tools that pop out, you're like, wow, I didn't know it could do this, it could do that. So it's definitely one of those, I would say, best kept secrets. So
Well, funny enough, on the same subject that you were talking about, Rebecca. So my best friend here, her son and my son were playing tennis last night, taking a lesson. So meanwhile, we were sitting there chit-chatting. We got into, talking about retirement and her account with Edward Jones. Now, she has no clue about what we do, like zero about the alternative space, although her husband is like a high-end handyman. So like they are in the space, but they aren't into the investment space, right? He just makes money by fixing other people's things. So we were talking about that. And she's like, yeah, I think I'm doing really good in Edward Jones. So I sat there next to her, I'm like, without like crying, I'm like, I'm sure you're doing really good, Jackie. And she's like, why are you being sarcastic? I'm like, I'm not being sarcastic. I'm like, this is your financial advisor telling you you're doing really good? I'm like, have you actually looked at the numbers? She's like, yeah, I look periodically. And she used to be like 10 years ago, like a commercial officer for a bank. So she thinks like she's got it all, like kind of, one of those things. So I'm like, okay. I'm like, okay, so give me the numbers since you know. What did you start? What was your initial balance in 2024 that you started with? And what did you finish it with? She's like, well, like 55,000 over. And I'm like, when what amount? And she's like, started like scrambling. So obviously the amount wasn't accurate because she just didn't want to like get caught. But she's like my best friend here. I'm like, look, I don't care, what it made. I'm just curious, and you're curious to know how to maximize. So just look, all I'm asking, you don't need to give me a number. I don't care to know what is your balance in your retirement account. I just am curious to know, what did it make? Anyways, long story short, it took us like 30 minutes to get through that. And then she goes, well, I opened this in 2012. Let's see. So she keeps clicking for this app in Edward Jones. And she goes, since 2012, so this is what, 13 years now, her weighted yearly average is 6.57. And I'm like, there you go. Where's the 10%? So she's like, well, yeah, but the ups and downs, when you're doing really good, you're doing really good. I'm like, yeah, but when you're doing really bad, you're doing really bad. I'm like, now imagine, and I just blurbed it out. Imagine if you were to take your $500,000 and put it at 12%. She's like, well, but it's risky. I'm like, it's the same concept, but you could diversify it. You don't have to put the entire amount, but just think about it. In the same 10 years, you would have had double of that amount. So I think it's just really hard for people to I don't know, get out of what you're used to, what you're comfortable with, and look at options. I mean, we were talking about the same thing, leveraging. Like she's like, I would like to buy a rental here where we live. and keep it for appreciation. I'm like, it's not worth right now. You're literally going to spend your money just paying the bills unless you find like a massive upside. And today, in today's market, I think most of the markets are actually pretty inflated. I mean, I see some flippers here and there go at it, but I think, I don't know. Do you guys know any hot markets right now where there is a flip opportunity?
All places very far from where I live. For those who don't know, I'm out here in Hawaii, so
Well, you are very far.
yeah,
But I see some people with better backgrounds than you. I'm sorry, Alan.
yeah, that's true.
Of course,
Yeah, I
it's
mean,
where you
it's not-
actually live,
It's not
but
exactly happy hour here. I mean, you guys might be drinking beers. I'm stole one of my son's energy drinks because it's that time of day out here. So
you're still waking up.
yeah,
Yeah, I would
playing hooky from my day job actually. So
there you go. Yeah, well, tell them this is important,
oh, it is. Yeah.
Yeah, I think what you just said, Lena, every market's a little different. I know in Florida, I listen to the different investment groups and gurus out here, and they're all really focused on MTRs and STRs. So midterm and short-term rentals to make the numbers work. Even in the multifamily sector, they've pretty much turned down the dial and went on vacation for a few of those people, unless they have a deal still in the works, or they're building, which again is offering them some kind of upside. But as far as buying or picking them up to flip, fix them up in Burr, multifamily or whatever that is, it's gone a lot slower. So midterm, short term numbers still work, and even they're tighter. I mean, at one point, off a single family home in our area, you can make like $3,000 a month, and now 1,000 to 1,500, which is still good, but it's about half what you were getting before because you're paying about 25-30% more for the house, and then you have the insurance cost. So numbers are getting harder.
Let me ask you that, guys, on the same topic. So another prospect, and only because I'm noisy, so I'm like, well, let's talk. So this guy is French, lives in Florida, I think in Miami. You guys actually met him at the Money Show in Miami. He was talking that his house is all fully paid off, right? That he lives in. So I'm like, well, he's like, I don't have a lot of cash. He's like, I'm thinking maybe 50,000, like I'm in traditional stocks and stuff like that. I was like, well, what about your own house? And he's like, no, this is like, and I'm from France, so I'm old school. Like if once you own your house, you don't touch it. And what are you guys' thoughts on personal house equity? Because I was like, why don't you pull not 50%, not, pull 30% out, invest it. You're like literally wasting time and money by not doing it.
I call Alan to go ahead and answer
Yeah.
that question.
I've got a thing called an all-in-one mortgage. Are y'all familiar with that vehicle?
Yes.
So it's a combination of a mortgage, a line of credit, and a sweep account and a checking account. And you're able to, pay all your bills every month. Your income comes in, it gets deposited. You pay your bills out of that. But every dollar of income that hits this thing from that day forward, you're not paying interest on your mortgage for that dollar, right? Then when you need the dollars to pay bills, you pull out, pay the bills. But you use this thing, it's combining the bank and the house kind of all into one, I'm probably not explaining it very well, but it allows very easy access to the equity when you need it to do like flip investing is just something that I'm into, or if you need to pull it out to pay a life expense or anything like that. But when you do have positive cash flow, you're basically paying down your mortgage and not paying interest on that part that you're able to do without, and stick it in there. So it's nothing
Alan,
like
I
a
think-
conventional mortgage. Go ahead, Sean.
Is it like a HELOC? Sorry.
It's not. I mean, a HELOC is like one part of it, but
Okay.
but it's also a sweep account. So every dollar that you deposit gets sort of, goes against the loan.
Yeah, Rebecca and I
immediately.
were just talking about it, Alan. So
Yeah.
just to clarify, I think you're talking about basically whatever you get paid from your active income, you would
Mhm.
dump it all into this. You wouldn't put it in the
It
bank.
immediately pays off that part of the loan, right?
Correct. And then you
until
can use
need
it
the
from
money. Yeah,
there.
pull it back out from there. right?
I think Rebecca and I, we were going over this. I think on average, people are paying off a 30-year mortgage in like 3 to 5 years doing this. You know, if you have additional, if you're not overspending what you're making, you know,
If
if you're
that's
not
your
living
focus.
above your
Yeah.
needs.
Mhm.
So you could even pay off your house quicker, or like you said, Alan, which I like, and what Lena's referring to is let's deploy the capital. I mean,
Mhm.
yes, you're going to pay your house off faster, maybe pay it off in 15 years instead of 30, but now you have all these other cash flowing opportunities you're investing into, which is increasing the amount of cash coming in, which means one day you can turn off that active and say, hey, I can live off my passive and still pay off my house.
Yeah.
So yeah, I
The other
love
good
the
thing
idea,
about
Alan.
it is it's not a P&I, it's interest only payments for the first 10 years. And then
Nice.
for the next 20, because it's a 30-year, structured, mortgage type instrument, then you have to pay off the P&I. But you can always refinance. I mean, I think I learned recently that the average length of a financed deal on a property is 7 years. So people are refinancing all the time. But anyway, it's a great instrument for a great way to access equity in your principal residence. And you can get these kind of loans on other properties too, you know.
Now I'm curious, Alan, since we're picking on you, sort of.
Sure.
You said that you use the money for quick flipping, but you're not flipping houses. So
Right.
No, no.
what flip
This
investments
is
are you using?
yeah, and Sean knows what I'm talking about because he came out to this event out here in
Oh, gotcha.
Honolulu. So there's an outfit called Tardis with a model called the Income Snowball that basically involves deploying investments, getting the returns on those investments, combining that with your monthly cash flow, and then reinvesting on a fairly quick cycle. And then when you reach a certain amount of cash flow from that approach, you can increase the amount of subsequent investments that you make, and you can invest in anything that cash flows, basically, or anything that has a return. So I've been doing that since 2020, and I got introduced to things like self-directed IRAs, all-in-one mortgages like we're talking about now, whole life insurance and other similar types of insurance to access cash from those as ways to sort of supercharge this approach.
Gotcha.
So that's what I meant by that. So
Awesome.
like some of my investments are with you guys at BQuest because I met Sean and Martin at last year's TARDIS meeting, which was in Maryland, and both of them were just out in Honolulu last week for the one we just had. And what you guys are doing there really fits our model really, really well. The legacy fund and the income fund that you have and some of the other stuff. So I'm really enthused about what you guys offer because it works very well with what we're trying to do to increase cash flow over time. So hope that answers the question.
Yeah, thank you very
thank you.
much.
If not, check out tardis.com, I guess.
Yeah, if anybody is interested in TARDIS, we do have a referral link we can get out to you. Just reach out to myself or Elena. Somebody say something?
Different question.
Yes.
What about any ideas as far as good place to park short-term cash? Bequest is more long-term. Just thought I'd throw that question out there.
I mean, what
how
Alan just
short term?
mentioned could be an option. Paying down one of your properties and have the ability to deploy it still.
Yeah, and what do you mean by short term? Like, are you
How
just
short?
looking to put in and pull out right away in like a month?
Yeah, that kind of flexibility. Right now, I've got Fidelity preferred and doing 4.11. But is there anything better out there that folks are aware of? And I can, within 24 hours.
What was the amount you mentioned? The rate?
4.
Paul?
So Fidelity,
4.1.
But like a high yield?
yeah.
Are you looking to use, like, you're wanting to put it in and use it for something?
I'm just saying I've got cash sitting in there, and is anyone aware of something that's equally flexible but yields higher than 4.11?
Yeah,
Yeah, I mean,
I
you can
can.
do
Yeah, go ahead.
sorry, I had a lag. Go ahead, Sean.
Yeah, I was gonna say we do have some new bonds within BQuest. Even I'll send you the link on it to look at. And then I know where Rebecca's going to, so it gives you a couple options to look at. Go ahead, Rebecca.
Yeah, you can still do that with insurance. I mean, it comes to how that illustration is designed and structured properly. But again, I've got some clients that they put in a good chunk of money and they're pulling out 90% of it right away. And depending upon what company we use, you can get anywhere from 6 to 8% on your money. So when that money is sitting inside the policy and you pull it out for leverage, you're basically borrowing against, you're using the insurance company's money. So your money is still growing.
Okay. I'm aware that there are stocks like TSLX, Sixth Street Specialty Lending, they're doing 9% right now. It is a stock, so you have that risk, but there are those sort of instruments also.
Yeah, so not to go deep on this, but I can just show you the Bequest bond that was approved for both accredited and non-accredited. Not something that it's on our website, but not something we really push on a lot. We have had a few of our current investors reach out and say, hey, what can we do for our kids or grandkids to invest? So, I mean, 5, 6, or 7, depending if you're looking for immediate 6-month or 12-month. And this is a non-accredited tool, but it's for both accredited and non-accredited, of course. But yeah, I can show you that on our website. I'll send it out to you. But yeah, I think that'd be a good idea to look at both because you also could add some life insurance power there to you also. And in both cases, I mean, you have full flexibility no matter what you use the money for.
Interesting. Yeah, I'm not aware of all the nuances around the whole life, but would be interested in learning more about that as well.
Cool.
Well, one of the other things that we're planning to, since this is our first happy hour, is dive into stuff like that, right? Just bring in topics like that where we can really, dive deep into how exactly an illustration would work, where something like that, short term or long term, for different vehicles, right? So, like we talked, like fix and flip is just one of the sides, but I think the audience is so big. It's just they have no idea, a lot of people, that you don't have to use your entire hard earned money and put it at risk. You can use somebody else's money, and the same thing, we're going to try to cover a lot of these things, hopefully on a monthly basis, and if it takes off, maybe on a bi-weekly basis, and try to get a lot more opportunity for folks to hop on and just learn from each other and have an open forum, if you will.
Yeah, thank you, everybody. That was amazing. Thank you very much for everybody's input. Obviously, any questions, you can reach out to any of us. Super excited. Obviously, we have to offer some free things for anybody who doesn't yet have any of our tools, which you can use for any other investments. Like obviously, the compound calculator is fun to play with. Income statement. I know quite a few people on here already have that and sort of took the one that you already personally made and merged it. But the SWOT analysis tool, I think I've had 2 people now reach out to me recently that started playing around with that for their deals that they're looking at, part of their due diligence. So I think that's a really neat thing. They're both obviously TARDIS members that are now using the SWOT analysis as part of their due diligence. I know that there's a big push for people to use AI for due diligence. That's a great way to start. I'm just going to remind everybody that AI, consider it your first draft assistant. Don't consider it your final documents or anything. I've seen some people get embarrassed. Very intelligent people get embarrassed by AI. So always review what you're looking at. But to add some kind of SWOT analysis tool as part of your due diligence is pretty neat. Any additional questions, or if you'd like to schedule a strategy call with any of us, you can scan this right here. We are going to try to get this recording out soon. Kayla will, and our marketing will assist us with that. And I have the request from a few of you, like Paul, we'll get you over that information. And I'm going to reach out to Specialized Trust because they actually emailed me out, and I totally forgot to get back to them because we had like 7 self-directed RA companies reach out to this year for us to do webinars with, which we did. And thank you very much,
Great.
Lena. When I heard Lena share this with me, I knew this was our first one. I'm like, yeah, we got to do this happy hour. I mean, she basically fed it. We talked about doing this happy hour for a while, but we were trying to think of something to do, and this was a perfect call that she got. So I love sharing back and forth. Thank you very much, Lena, for your knowledge, background, experience. If you guys think of other topics, definitely let us know. And I want Lena to get the final wrap up for us, if you don't mind.
No, I appreciate the opportunity. Again, I think from a personal perspective, being in the industry for the past 13 years plus, I've learned a lot, but I think, that you never stop learning. And I would love to continue learning myself. And the only way is to force yourself to attend events, get on webinars, and just, again, I think it's the most important part is just listening from people who have done it and have the experience. And I think that's what I'm looking forward more than anything, just seeing what is out there. How do we all maximize and take from each other the experience that we have to really, boost the future returns and continue building wealth.
Awesome. Thank you, everybody. Thank you very much.